Today I have a rising star in the investing world. I believe he's probably 20 years younger than I am, but he knows exponentially more at his age than I did when I was his age. His name is Brad Freeman, and he runs StockMarketNerd.com. This is a Substack newsletter with just about 26,000 subscribers. He's got 100,000 followers, I should say, on Twitter. I think I have like 14 or 9 or something like that. I forgot. It's much less, much smaller number. Anyway, Brad is here to share his knowledge. He is a prolific writer, and I mean prolific, on the topic of investing, not just broad picture stuff, but going down into company details. I'd like to unpack some of that, what drives him, some of his lessons, both for advanced investors and for new investors. Brad, thank you very much for joining us today.
Thanks for having me. Way too kind with the introduction. I very much so appreciate it and excited to dig in.
Let me start with just who you are in terms of this kind of Wonder Boy. Wonder Boy kind of sounds demeaning, but you know, this relatively young guy, and you've amassed a lot of knowledge. And I say that's special because I've been in the finance field for a long time. I've known people who are young and who know a lot about stocks, but they've tended to be in investment banking programs or working at a hedge fund. In other words, it's hard to unpack, to disambiguate the motivation. Like, are they just doing their job, or how much of it is like their own individual passion? You, however, stand alone. You're basically independent, and you're sort of all passion. So when you're writing these long things, it's coming from the heart. You know, there's no managing director sitting there making you do that, and that's unique because this stuff's a lot of work to do. Even if you are passionate about it, let alone if you're not. So you have a red hot fire. Can you tell us how that came about? Like, what's the genesis story of Brad Freeman, the investor?
Yeah, so independent, but definitely not doing this alone and without a great support system. So wonderful mentors that I've grown up having the luxury of learning from. My father and my 6 years older than I am brother, who are both very intertwined in the field, and were both very patient teachers with me. So from a very young age, about the time that I learned arithmetic, learning what a price to earnings ratio was, learning what revenue and revenue growth was, just willing teachers and eager teachers, and I was, like you said, very eager to learn. But going forward, really starting in undergrad, started to kind of dabble in financial markets, and didn't do so effectively at all, as is usually the case as an 18-year-old kid who doesn't really know anything yet, but thought I knew a lot. But now I can look back and confidently proclaim that no, I in fact did not. But going through undergrad, it really started with finishing my undergrad degree and then starting to work at a registered investment advisor. So it was in the Metro Detroit area. It's called Diversified Portfolios. It's a smaller shop. But from there, it was really learning how to digest an earnings report, how to digest an investor conference or a 10K or a piece of buy-side research, and synopsize it and tie it in a neat little bow for my bosses and for the people I was working for, to give them the 5 or 10 or 15 or 20 most important points, or everything impactful that they need to know while cutting through the noise or cutting through the fluff. And that really... I guess you could call it a skill set, translated well into writing eventually for the Motley Fool right around 2020. So when the pandemic came and switched to remote work at the RIA, and we weren't super prepared to switch to remote work, so there was some time on my hands, and did some writing for Motley Fool, and really enjoyed it. Learned from some awesome people who I know you're familiar with, like Brian Feroldi, and many others. And
Brian's a great guy. Yep.
Yeah, great guy. And really loved working for the Motley Fool. I was kind of tied to an industry or two where I wanted to kind of branch out and talk about the companies that I was owning and that I was holding, and that I was most passionate about researching and digging into most deeply. So I started writing on Substack for myself. I think it was July 2021 or something like that, using Twitter as a top of funnel for growth. And I skipped an important part of where kind of hopefully the legitimacy comes from, and we'll have to build that legitimacy over time as a 26-year-old kid, but was a master's in finance from the University of Michigan, so got that notch under my belt, and from there just really started writing and started researching and started falling in love with building a puzzle of a fundamental bull case for a stock.
I saw your most recent update, and the parenthetical note said 22-minute read. Supposedly, young millennial, I guess you're on the young end of the millennial bracket, but millennials, Gen Zs, you know, they don't have time to read 22 minutes, but or write, let alone write something that takes so long to read. Is that just a misconception? Why do you feel you go so deep when at least your generation, Brad, has a stereotype for being, just Twitter, Instagram, Snapchat, one quick point kind of people?
Yeah, so I kind of reject the notion that some people kind of convey that individual retail investors can't beat the market, no matter how hard they work, no matter what approach they take. Stock pickers from the retail side just they can't beat markets, and it's hopeless, and just invest in an index fund. And I think if you have the time and the discipline and the motivation and the very baseline skill set, which is really just a bunch of arithmetic, to actually research these companies, to learn a bull case, to learn risks to that bull case and what could go wrong, and to buy and verify. Verify meaning tracking these investor conferences, tracking earnings reports, tracking how things went. I believe that paired with the fact that we don't have to post quarterly returns for our investing clients every quarter, that ability to actually dig in and to digest and to spend the time learning information that some people just aren't willing to learn, I think, and I found to be a pretty tangible edge in investing, and that edge kind of the effect of that is, as a writer, is spelling out all of those ideas and all of this news and every relevant piece of information, which those relevant pieces of information are quite constant and quite frequent for these readers. But the one caveat is I'm pretty confident that most of the readers don't read every section, so I do try to split it up very neatly and in a very organized way. So you could see, yes, I care about that company. Nah, I don't really care about that one. I'll read the macro news, and so maybe an 8 or 9 minute read instead of a 22-minute read. But I mean, yeah, brevity is not my strength. I think to put it that way. I mean, my last deep dive on Shopify was a 60-page novel, and that was as short as I could make it. It was 100 pages at one point. So I really love getting into the weeds. It's very gratifying to me. And for readers, it's taking whatever information you want from that, and leaving whatever you're not really caring about or whatever's outside of your niche.
And it's a great way you framed it. As far as individuals can beat the market, most are not going to, and most, in my view, should just buy ETFs. It's going to be a minority of people, and that means a very small minority of investors who are interested enough and engaged enough in individual stocks to try to beat the market, but they can potentially get outsized returns. And part of that is because most people don't want to dig into the weeds. Most people don't want to read the business case. Most people don't want to do those things, right? So if it were fun, if everybody did it, it would be a lot harder game to win. So again, I wouldn't advise it to most people. Most people should just buy an index fund. If that's your thing, you're not going to be happy trying to be an investor if that's not you. But if it is you, then great, and there are returns available. Let me drill down, Brad, to something you wrote about in that 22-minute read, or a small segment of that, I should say. You mentioned high valuation and multiple expansion. That's when, let's say a PE goes from 10 to 13 to 15, whatever it is, as main reasons you sell. But then you also said sustained, like multi-quarter poor financial performance is a reason you sell too. That makes sense. I guess my question would be, if we keep those things in mind, especially overvaluation, to start with, how do you decide whether okay, this stock is just too rich, I'm going to sell it, or no, it's a little bit rich, but this is a good long-term winner in the long run? Because I think a lot of people have that dilemma.
Yeah, I think it's splitting it into two buckets for me. So it's trim decisions and it's liquidating decisions. So in terms of trimming, it is very tightly tied to valuation, because I mean, as you well know, we're chasing the most compelling risk reward we can find in public markets. And as things get more and more expensive, yes, they can keep getting more expensive, but risk reward inherently it gets worse, and the probability of outsized returns falls. So the very general rule of thumb that I use, and there are going to be many bright people who use a related but very different way of doing things, is I'm in the Peter Lynch camp of loving PEG ratios, so price to earnings ratios divided by earnings growth, and to kind of smooth out the impact of somewhat lumpy earnings growth for some companies. I do generally try to use 2 or 3 year CAGRs, or compound annual growth rates, for profit, to kind of to give an idea of run rate profitability, more so than 1 year of profitability versus another, to understand what they more precisely deserve in terms of long-term multiples on a several year basis. But as a general rule of thumb, For me, and again, these are my sell rules, and you can have a completely different and completely effective way of doing things. But for me, it's as a company, Eclipse is a 2x PEG ratio, so their price to earnings is more than 2x the rate of their overall earnings growth. I generally do trim 5 to 10% of a position, and then in increments of 25 or 50 basis points, which is a fancy way of saying 0.25% or 0.50%, I do continue trimming. But there's a bit of nuance to that. So for companies like Uber, for companies like Airbnb 2 years ago or 2.5 years ago, there is so much cost cutting and cost rationalization happening in these business models, and there is such a brisk pace of upward earnings revisions happening that I don't think that's done, and I don't think these upward earnings revisions have fully captured how these businesses are evolving, how they're changing. Amazon's another great example with their switch to a regional fulfillment footprint, but with these companies, that's why there's a 25 to 50 basis point range, and I generally let them creep up closer to 50 basis points because I don't think forward-looking PEG ratios are properly crediting what their profit growth is actually going to look like. And then for other companies, and I know we're going to talk about CrowdStrike a little later, so I won't dive into it yet. But another opinion is just that the best companies in the world, the highest quality companies in the world with the deepest moats, the longest runways, and just the longest track records of success, naturally deserve a bit of a premium versus other companies that may have less certain profit compounding, may have less certain success in their future. And that's also sort of when I let it creep up to that 50 basis point range. But moving on, and I'll try to do this a bit more quickly because I was a little bit rambly, so I apologize. But for the hold or liquidate decision, that kind of separates from the valuation talk and really gets into fundamental health and fundamental quality. Because for an expensive company with an extremely long runway, I'm generally willing to hold a smaller core position if I think maybe it's just a bit ahead of its skis today. But in 5 years, if things go extremely well, it certainly won't be ahead of its skis based on the price today. But for holding a position or exiting a position decision, sorry, a bit of a tongue twister, but it really comes down to fundamental health and fundamental quality. So disappointing revenue growth for several quarters in a row, margin deterioration for several quarters in a row, the balance sheet just exploding with high risk debt, or for maybe a creditor for just low FICO debt or just high delinquency, high charge off rate debt, just bloating the balance sheet and creating future liabilities and future losses, or things like stock-based compensation that's tied to somewhat egregious performance benchmarks instead of things like pace of free cash flow compounding or pace of revenue growth. So just misaligned incentives or underperforming results on a several quarter basis because these companies are not perfect. And as the newsletter said, one strike you're out is a bit harsh. So, I mean, Microsoft messed up with Windows 8. Amazon's messed up several product releases. All of these companies, the best companies in the world, all have missteps. But it's when these missteps become more consistent, when they become more expected and more routine, is when they become more alarming to me, and is generally when I will exit a position.
So I want to ask about PEG in a second, just because the average person may not know exactly what PEG is. But just very quickly, let me dog you or something you mentioned. So if we do have a company that has several quarters of bad performance, some bad stuff happens, balance sheet gets worse, they miss some stuff, it's rational to say, yes, I want to get out of this company or at least trim my position. But usually accompanying those negative pieces of information is a decline in the stock price. So for every Brad Freeman that says, I'm not liking this, there's another Brad Freeman on the other side somewhere saying, well, I've been eyeing this stock and it was kind of expensive before, but it's getting a lot cheaper now, and maybe they're going to fix these problems, and now's the time to buy. Like, how do you rationalize that? Because if price never moved, it's a lot easier to understand investing. But the thing is, price usually moves roughly, in proportion to good news and bad news.
Yeah, no, definitely. And when I think it just goes back to chasing the highest probability of success, chasing the best risk rewarding, and setting ourselves up the best way we know how to with our finite capital to deliver returns in excess of markets. And it's accepting that sometimes I'm going to sell a company and they're going to figure something out and it's going to raise 50% higher, and maybe the fundamental case at that point would justify actually re-entering. But it's accepting the fact that I'm definitely not going to sell companies or liquidate positions that are just guaranteed to continue falling. Now, there's going to be the tattooed chefs of the world that I sell at $6 a share and kind of patting myself on the back, but they're now declaring bankruptcy. But there's going to be good RXs where They really struggled with their Kroger relationship, but they just signed a new deal with CVS where maybe volume is going to be a little bit more reliable. So they are being rewarded right now. But, markets are a zero sum game, and that's somewhat inevitable where the making of a market is inherently tied to disagreement and one person seeing things completely differently than another person does. So for me, it's just accepting the fact that sometimes I'm going to be wrong and just setting myself up the best way I know how to deliver those excess returns, which is how I'm evaluated based on successful or don't know what I'm talking about. So it is just, it's an inevitable part of how we do things as I've come to know, as I've come to learn. But it's a part that I have to accept, and a part where I have to just allocate dollars in the highest conviction ideas I have.
Makes sense. Makes sense. I would actually say one thing, I'm pushing back a little bit. I would say markets are a zero sum game in derivatives markets for sure, in options and futures, literally a zero sum game. In equity markets, maybe in a short term sense, but I would say in a long term sense, one of the best things about markets is, in a way, they're not. Like, if you look at, GDP growth of the U.S. and stock market growth of the U.S. over the years, I mean, humanity gets better at just richer and better at adding more value to humanity, and just wealth grows. And in fact, I think it's almost a problem because we're creating a society where you're either on the compounding train or you're not. If you have enough money to invest to buy a house, first of all, but also to invest in stocks, your long-term future, especially in retirement, looks way better by the year compared to someone who can't. And that's always been a little bit true, but I think it's becoming more true by the year. So, maybe this is my 22-minute read ramble, but, I tend to think in the long run, the cool thing about the stock market is everybody kind of wins together as long as you're participating. But in the short run, yeah, I think it is more of a zero-sum game on a trade basis.
Participating on the long side, you mean, right?
Yeah, in the long side.
Yeah, for sure.
Yep. Okay, so let me go back to PEG. So you mentioned PEG, price to earnings growth ratio. Peter Lynch made it famous. He ran Fidelity's Magellan Fund, and I want to say did something like 27% return per year
Yeah.
when he did it. It's a very, very famous, and he mutual fund manager, buy what you know, was his credo. And the PEG concept is you take the price to earnings of the stock, let's say it's 13x, right? And you want earnings growth to be roughly, if its earning growth is 13%, excuse me, that's a PEG ratio of 1. Like, that's pretty good. If earnings growth is 26%, that's a PEG ratio of 2. That's really, really good. If earnings growth is 2%, then it's substantially below the PEG, which is not so good. Then we dive in and say, what earnings growth? Often that's forward earnings growth or forward estimated earnings growth by some kind of Wall Street consensus. They often do 5-year annualized. I don't know what you use. Can you just briefly explain, like, how you said 2 to 3 year? Is that a forward or is that a look back ratio? Look back number.
Yeah, and sorry for the ding. I'm trying to mute the.
You're a popular guy, Brad. We expect that.
Yeah, so I got a bit distracted by the dinging, but you were asking kind of what growth rates I'm using and what time period I'm using in terms of growth rates.
Yeah. Are you looking forward or backwards for your PEG growth? And you said 2 to 3 years, I think, was the time frame.
Yeah, so as you go further out, 2 years down the road, they become less and less reliable. They become more and more speculative. But as you said, I do like to use more than 1 year at a time, just in case there's some lumpiness associated with the model. So if I'm using, hopefully a 3-year time horizon, although with the pandemic, some of these 3-year comparisons have become super wonky and super weird. So sometimes 2 years, but it'll be the trailing 12 months, it'll be the current 12 months, and it'll be the next 12 months. Just so that we can use a longer time period and we can smooth out the
I see. So baking in a little bit of the past, the current, and the future. Interesting.
Yeah.
It's an annualized. It is a 1-year annualized rate, but it's using those 3, periods as the inputs. Yep.
Exactly, because I don't love using sell side estimates from 24 months from now, just because they're inevitably going to change so much. So it is relying on previous data and then using the most current forward estimates, I guess, is a good way to put it.
Yeah, that makes sense. I mean, in principle, you're always buying the future when you buy a stock, but sometimes looking back is the best way to know the future. So speaking of future, I looked at your portfolio online. It's great of you to put it online in the first place. And I noticed that you mentioned Meta, Amazon, and CrowdStrike as the 3 highest quality growth companies in existence, or something like that. I think we all know Meta, I think we all know Amazon, but what is CrowdStrike and why does it belong in that club?
Yeah, so definitely not the highest quality company in existence, but in that bucket, in my specific portfolio of highest quality companies, which I would lump with Meta and I would lump with Amazon. But for the sake of not turning this into another deep dive, because I know you don't want me to answer this in 30 minutes, but I'll do a quick quantitative section,
Prepared.
a quick qualitative section. But quantitatively speaking, so it is the only company you can find that combines its scale, its revenue growth, and its free cash flow margin. So
And
it
what
is.
does it do? Just like first off.
I'm sorry. Oh yeah, it's an so I hesitate to call it an endpoint security vendor because now it does so much more. But endpoint detection and response (EDR) is its bread and butter. So competes really tightly with Microsoft and with SentinelOne. From there, and from there, the branching out is an important part of the bull case actually. But from there, it is branched out into things like log management. It bought a company called Humio to do it, which is basically observability of data, which kind of puts it more closely competing with Datadog and those types of companies. It does a bit in identity security, but it's not an identity broker like an Okta is. It more so is it uses identity to stop what's called horizontal movement within a security environment. So it stops the I penetrated the most vulnerable part of a IT ecosystem. So now I have permission to penetrate anything because I've already gotten in once. So it does something called implement zero trust, where as permissions get more and more strict, you have to continue verifying yourself over and over again, which is a bit tedious, but also is just good security hygiene. But so that's sort of what it does. I think it has 24 modules at this point. But endpoint is definitely the bread and butter, and whether it's log management, whether it's identity, whether it's now working in cloud workloads, it's all from this endpoint security aim. But it's the only company. I don't know. I think it's going to cross 3 billion in annual recurring revenue this year, but it's the only company at that scale that can say we have 30% free cash flow margins and we're compounding revenue in excess of 30%. But not just financially speaking, but well, this is sort of related to financials, but that's really the base case, and building upon that, looking at data from IDC, where its endpoint market share over the last, I think it's about 10 years now that it's been in business. It's gone from 0%, obviously, to now I think it's over 17%. It has eclipsed Microsoft as the largest endpoint vendor in the world. Its endpoint security share continues to grow quarter in and quarter out. If you look at SE Labs or Gartner or any of these third-party independent valuation firms that don't do any kind of shitty pay-for-play stuff, which is a conversation for another time, but they consistently lead in all these breach protection tests, along with SentinelOne, which is another really great product that has a bit more fragile go-to-market. But from CrowdStrike's perspective, that has really why it's so impressive quantitatively speaking, and qualitatively speaking, why is it gaining so much market share? Why is it growing so quickly? It goes back to all these successful extensions into other things beyond endpoint, where you're leading in efficacy and you're leading in cost and endpoint. And when you can layer on these other modules, these other product categories, with virtually zero customer acquisition cost for CrowdStrike, it creates vendor consolidation, it creates simplicity, and it creates lower cost while building efficacy, which is allowing them to almost emulate, not quite emulate, but sort of start to emulate the powerful enterprise Microsoft bundle, which is how they built themselves into a multi-trillion-dollar company. But kind of rambling now, and I see it looks like you've got an idea, so I want to.
I was just going to jump in because I probably understood 5% of the technical description, which is a testament to how much you know and how little I do know about this company. But one word I wanted to unpack. So endpoint security, just for the rank beginner, what is endpoint security versus like something else?
Sure. So it can mean protecting my laptop within a software ecosystem, like maybe Accenture has a bunch of consultants that have Apple laptops, and it's making sure that the permissions and what they're actually allowed to access is clean and hygienic, and who's accessing that from external services is hygienic. But it can also mean freight containers. It can also mean a cloud workload. So it doesn't just have to mean a piece of hardware technology. It's basically just any endpoint use case it's being put
At the user level versus in some centralized database or somewhere upstream.
You got it. Exactly.
And you want hygienic endpoint. You want a hygienic endpoint, it sounds like, to double my jargon knowledge now.
You want great hygiene to make sure that everyone can only access, it's minimum permissions. Anyone can access only what they're supposed to have access to and nothing more. That's the goal.
Makes sense. Makes total sense. Shifting gears, your portfolio, which I guess we can, with your permission, flash a graphic online here in the editing. I just eyeballed it. I don't know all the names. I know probably most of them. It kind of skews to either tech stuff or well-known consumer brands. Is that by choice, Brad, or is that just kind of like where you're at right now? And if you later get into, I don't know, some kind of, deep energy industry knowledge, or some kind of additional knowledge, like you might add that. Or is this just kind of where you're at, or is this where you think is literally the best opportunity?
Yeah, so I am seeking out profitable structural growth stories with tangible qualitative edges of just tying this in a neat bow. Tangible qualitative edges, long runways, dominant market shares, operating leverage. So those are really the high
IGP
level.
points. Yeah.
Yeah, yeah, and where that kind of takes me often is in the world of tech. So programmatic advertiser players like the Trade Desk, or endpoint players like CrowdStrike, or DevOps players like JFrog that have over 90% of the Fortune 500 on their client list. But there are also other, I guess, adjacencies within the portfolio. Like, I mean, Progeny is a fertility benefits manager. Revolve, I guess, is an e-commerce player, but they're really just an online fashion retailer.
Yep. Yep.
So it's seeking out companies where incentives are aligned with shareholders, where financials look good, where liquidity looks good, where the opportunities versus the risks look good, and that often takes me to the world of tech. When I'm seeking out innovation and disruption, technology is really the center of that most of the time. But it's not strictly looking at that. It's just looking for ideas like that, and a lot of the time it's in that bucket.
Impressive, impressive. So, Brad, more big picture wise. So you are wise beyond your years in terms of investing. In my view, if you were twice your age, I'd still be impressed with everything you're saying here. But the flip side of that would be if someone is new to investing, and I use my 14-year-old son as a proxy often for questions like this. Looking at this, they may say, "Wow, this is impressive on one hand, Brad's knowledge, but." This just seems like a steep hill to climb. Like, how do I get started? How do I build my way to that knowledge without just being so intimidated? Like, what's your advice to newer investors?
Yeah, and I think it goes back to a really important idea that you shared earlier on in this episode, where there's nothing wrong with investing in index funds. There's nothing wrong with investing in Vanguard's broad-based index or SPY or anything like that. And I think if you are just starting out, if you are just getting your feet wet, this is going to sound a little bit boring if there are people listening in, but it is seeking out those low-cost index funds where a ticker like VOO is a great option and a go-to for a lot of people. And then if you are passionate about stock picking, if you have the time and the drive and the motivation and the passion, it's learning. It's first learning three all-important financial statements and the ins and outs of GAAP accounting and how the plumbing of GAAP accounting works, and really getting into the weeds about how financial statements are structured, what they mean, weird quirks about them, and that does take some time. But fortunately, there are wonderful free resources online from MIT and Harvard and all these brilliant professors who are literally teaching us about financial statements for free online. So just type that into a Google search bar, and I'm sure you'll find it. But want to wrap this part of the conversation up by saying there's nothing wrong with just staying an index investor and just staying in VOO over the long term. If you have a 50-hour-a-week job and children, and you just really don't have the time to come home at 8 p.m. and just start researching stocks, because who the heck wants to do that? I just want to watch a sitcom and forget about life for 30 minutes, then VOO is completely fine. And you will build wealth investing in index funds, and you will take advantage of American innovation and global GDP growth and all of these secular growth stories that are powering gains over time. So.
Very well said, Brad. And to your point about the accounting knowledge, I kind of liken that to like a video game rule book. Maybe it's like a flight simulator game, something a little complicated. Like, you kind of just got to push through it. I know it's not the most exciting thing, but if you do want to take the Brad Freeman path, you do need to know accounting. I mean, there's no way, and basic finance, there's no way around that. Don't shortcut. I'd add Aswath Mortarin's material too, NYU professor, a great free resource as well for a lot of this stuff. So there's no, these days, there's no shortage of places to learn it. You do have to push through it. So Brad, final question. If someone is hearing this and says, I like this. In fact, I want to read that 22-minute read, and I want to read much more of that. Where can they find more Brad Freeman?
Yeah, stockmarketnerd.com. It'll ask you to subscribe, which will make me happy, but you can just click continue reading if you want to, and it's all free. And if you are interested in a ticker like a CrowdStrike or a PayPal or a Meta or an Amazon, type it into the search bar on the website. It'll take you to every article that mentions it, and go nuts. Because I have a lot of fun writing it, so hopefully people have fun reading it. But I'm a nerd, so maybe not.
Stockmarketnerd.com. And don't just read it. Enter your email, push subscribe. It'll make Brad happy, and that's what we want to do, don't we? Brad Freeman, thank you so much from Stock Marketer. Thank you so much for sharing your thoughts, your insights today, and would love to have you back on sometime too.
Happy to. Thanks, James.